Do you want a simple high win rate trading strategy that you can start using right now to consistently make thousands and easily pass your prop firm challenges? Well, today I'm giving away my exact rule-based supply and demand strategy. It's straightforward, repeatable, and actually works. Right here's exactly what you learn today step by step. How I use supply and demand zones for perfect entry and exit points. My simple trick to combining these zones with Fibonacci retracements to find powerful trading levels. The free moving averages I'll always rely on to instantly confirm the trend. How pivot points reveal hidden support and resistance areas where big players trade. And of course, how to easily align multiple timeframes to get crystal clear market direction. So with that being said, let's start with supply and demand. What is it? Demand zones are pretty much like the floor beneath the price. Whenever candlesticks touch a demand zone, the price typically bounces upward. Supply zones, on the other hand, act like a ceiling above the price. Whenever the price hits the ceiling, it usually drops back down. There are two simple ways to trade supply and demand. One is called range trading. You pretty much enter trades when price reaches supply and demand zone, anticipating a reversal back towards the opposite zone. Your exit strategy is straightforward. Simply close the trade once the price reaches the opposite zone. Second method is breakout trading. You simply wait for the price to break through the supply and demand zone, typically using one of the four formations: rally-based rally, drop-based drop, which are continuation patterns, or rally-based drop and drop-based rally, which are reversal patterns. I use these formations based on current market conditions. Sometimes I use none, sometimes I use one. Really depends. The target for breakout trades is usually the base pattern itself. So if your base pattern is 100 pips wide, your target after the breakout would also be somewhere near 100 pips. So that's supply and demand done. Let's move on to Fibonacci retracement. So Fibonacci retracement is the perfect add-on for supply and demand zones because they confirm entry points and help you pinpoint market direction. For example, here we have price consolidating within supply and demand zones. I've drawn the Fibonacci retracement from the recent swing high to swing low, clearly highlighting the golden zone between the 0.618 and 0.5 levels. So there are two clear ways you can trade this setup. First one is trend following trades. You could use the golden zone as the resistance area, looking for price rejections at these Fibonacci levels to confirm entry in line with the trend. Or you can do momentum shift trades. So if the price breaks and closes decisively above the golden zone, this indicates a potential momentum shift. You can then confidently switch your buying positions targeting higher price levels. I love using Fibonacci this way because it gives you clear market structure, price entries, and higher confidence trades. So enough of the Fibonacci, and let's talk about my three favorite moving averages. These are simple moving averages, periods of 20, which show short-term trend direction, 50 for medium-term market momentum, and 200 moving average to gauge the long-term overall market trend. So let me give you an example. You can clearly see a strong trending market. Notice how the price consistently respects the area between 20 and 50 simple moving averages. With the moving averages aligned bullishly like that, you would only want to trade buying opportunities, no selling. Trading against such a clear trend would lower your probability for a successful trade. So cool transition. Pivot points. Pivot points are another powerful tool I rely on. Trust me, it's so good. Think of pivot points like hidden supply and demand zones. For example, I like to use it in combination with the moving averages. So if you have a monthly pivot point just below the 50 moving average, that's a strong confluence already, indicating bullish trend is likely to continue. This gives you added confidence to stay with the trend and enter high probability trades because you're trading with the trend and institutional levels. Another cool transition, multiple time frame and trend direction. I use multiple time frame analysis all the time. It's critical because you always want to trade with the prevailing trend, never against it. So in this case, on my Euro USD trade I shared with my trading group, the monthly, weekly, daily, and 4-hour timeframes were all indicating a bullish trend. This gave me and my trading members an ideal opportunity to confidently enter the market on a pullback to a strong level of support. So by us leveraging mentioned the higher time frame bullish trend, it significantly increased the odds of success. So that was the exact overview of my entire strategy. Supply and demand combined with Fibonacci tools, clear moving average confirmations, pivot points, and precise multiple time frame analysis. Now, of course, there's candlestick formations, but we'll leave that for now. Okay, now we're gonna do some live trading breakdowns from my trading group. Here's a clear 4-hour trade setup we recently took with our VIP members. Let's break down exactly why we entered the trade, how it played out, and what we can learn from it. So here's some market context. We saw GBP/NZD clearly trending downward. Previous demand zone was broken, turning into a supply zone after a retest. By measuring our supply and demand rectangle, it gave us a clear target to aim for, confirming our bearish bias. Now let's move on to the moving averages. As we can see, all three of them, 20, 50, and 200, showing strong bearish momentum. Additionally, we had a clear rejection of the 200 moving average with a bearish engulfing candlestick. That was already a clear indication that selling pressure is still here. Also, we have a Fibonacci line which perfectly matched the 200 SMA line, providing a strong confluence and powerful resistance level to enter the trade. We also had pivot points. Although it wasn't that close, the pivot point was also broken downward, which signaled additional bearish pressure. Although my initial stop loss didn't cover the pivot point fully, because I wanted to maintain somewhat a better risk to reward, it still confirmed bearish momentum. So I still knew it's a high probability trade, even though I'm entering slightly late. 1 hour, 4 hour, and daily timeframes all showed bearish momentum, straight away giving us a high probability setup for a continued bearish push. Okay, now trade result and management. Initially, price pushed strongly downwards, quickly reaching our first target profit level. Our trading group members secured some profits and moved their stop loss to entry or even closed the trade out entirely. Really depends on their own risk management. However, shortly after that happened, a strong bullish engulfing candlestick emerged, respecting our previous low and pushing price back upward, eventually hitting our original and adjusted stop loss, whichever way you look at it. So what can we learn from this? In hindsight, I should have waited for the extra 4-hour candlestick to close, which would have allowed me to enter with a strong confluence. It would have been on the pivot point itself, including the 382 Fibonacci level and potentially the 50 moving average covering our stop loss. Doing that would have improved our entry significantly, as the market did eventually continue the bearish move, as we can see over here. So why we took this trade? Bearish structure on the supply and demand zones, bearish momentum below the moving averages, 200 SMA rejection, Fibonacci levels matching resistance, the 200 SMA confluence, pivot point bearish breakout, and multiple time frame alignment, 1 hour, 4 hour, and daily bearish trend. Right, enough of GBP/NZD. Let's move on to live trading breakdown number 2. So the next trade we took in our group was Euro/US dollar on the 4-hour time frame. Clearly trending upward with consistent higher highs and higher lows, showing us bullish momentum. Some context, we saw a bullish push upward, followed by an exhaustion pullback to the 50 SMA line. This 4 candlestick kind of stall sitting in the same place indicated sufficient buying demand. A bullish engulfing candlestick provided clear confirmation of strong bullish momentum, especially since it closed above our key Fibonacci level. So with that being said, let's talk about indicators. So the Fibonacci retracement, the candlestick closed clearly above the 0.382 Fibonacci level, confirming bullish strength. Moving averages, again, price bounced strongly from the 50 SMA and we had the 20 SMA sitting right below the candlestick. In this case, pivot points were distant, allowing us room for the price to move before it reaches those institutional order zones. Then we have the demand zone. The recent price reaction also aligned with clear demand zone, giving us bullish support. In this case, entry was straightforward. We had a stop loss of 40 pips below the 382 Fibonacci low, 50 SMA line, and the demand zone. This combination offered us strong confluence and excellent protection for our trade. Additionally, the monthly, weekly, daily, and 4-hour charts were all pointed in a bullish direction, giving us even greater confidence for the trend to continue. So let's take a look at the trade and talk about management. The trade played out beautifully, quickly hitting our take profit 1 and take profit 2 level. At this point, you could have easily closed the entire trade off at the top of the supply zone for maximum profit if you wanted to. Kind of makes sense, sitting on supply, close the trade off, happy days. However, sometimes you want to keep the trade or see what the market is gonna do next. So in this case, price surged up sharply upward, testing the monthly pivot point. This was a critical moment for everyone, especially in Forex. price rarely moves without a pullback. This is not crypto. Price aggressively approached the pivot line. We needed clear evidence to hold the trade or exit the trade. So it's important to remember that if the candlestick isn't closed, the move isn't confirmed yet. And in this case, before the 4-hour candlestick closed, price sharply rejected the pivot point, failing to close above our supply zone, confirming that selling at the pivot point would have been the most optimal move. Since it hasn't broken the supply yet, it's touching an institutional pivot level, you should definitely close the trade, because the amount of orders is going to be injected in that area zone is millions. So you really want to close at that area zone for the max profit. So what can we learn? Always monitor major pivot points for potential reversals. Price rarely moves indefinitely, especially after strong pushes like that. And also make sure to look at the candlestick closure confirmations, because without them, you never know whether the breakout is actually real or not. Right, live trading breakdown number 3. The next trade was AUD Swiss franc on the 4-hour time frame. And honestly, this one didn't go according to plan. But let's learn from it, because you learn from failures than successes anyway. So the initial market analysis was straightforward. We had a clear break of previous supply and demand zone, turning previous demand into a new supply area with a solid push exhaustion cycle. The indicators like the moving averages, price was hovering just below the 50 SMA on both the 4-hour time frames and the daily time frames, providing what I thought was a solid bearish confluence. Fibonacci levels, price hadn't yet broken above Fibonacci resistance level, adding confidence to the bearish trade. Pivot points, I saw potential room for price to move down towards the monthly pivot point as well. So what happened? I placed a 40 pip stop loss above the daily, 4-hour and 50 SMA line and Fibonacci level. A strong confluence. The initial target was about 20 to 50 pips down into the supply and demand base, potentially further if the pivot point was broken. Then you can kind of go for the higher take profit levels. However, looking back at it, there's the mistake I made. So the recent bullish engulfing candlestick on the 4-hour chart created a new high. I didn't see that initially, and that's where I fucked everything up. It signaled a potential start of a new bullish trend. Price was clearly forming higher lows, indicating a shift in momentum from bearish to bullish, which is also never a good sign. In hindsight, when I think about it, I should have immediately re-evaluated the trade as soon as the price decisively closed just above our Fibonacci resistance and the 50 moving average. This was a clear signal to exit early and reconsider the trade. As you can guess, my smart ass kept the trade open. The pair continued upward and hit my stop loss low. This trade was a loss, but it provided a valuable reminder that even after over 10 years of trading, we must remain vigilant and flexible, quickly adapting when the market signals a shift. As a beginner, it's very hard to do. Eventually, you will get better at it as you progress as a trader. I promise you that. If this helped you in any way, consider liking and subscribing. I've got more powerful breakdowns coming out, and I would also like to flex a little bit. This is a 10k FTMO account, and I was simply closing the trades off at 20 pips only, the minimum target profit I have for my signals. And as you can see, the profits are there, and we actually passed our FTMO challenge. So if you want to join our group, become a member, actually learn how to trade Forex, become a Forex Trading Lion. You can find more information forextradinglions.com. And for now, take care, Lions. Have a wonderful day, stay safe, and goodbye.